Hi, I'm Money Mike. I teach personal finance stuff the way it should have been taught in school. Today we're talking about mortgages, what they are, how they work, and why they sound simple until someone actually asks you to explain it out loud. Let's fix that. Okay, a mortgage is just a loan you get to buy a house. That's it. Why do people even need a loan for that? Because houses are expensive. You find a home you love and it costs $300,000. So unless you have $300K just chilling in your checking account, in which case, congrats, you're gonna need help. So you go to a bank and say, hey, can I borrow the money to buy this house? And if they like your credit score, income, and vibes, they say yes. That's a mortgage. Why would the bank be okay with lending you so much money? Because there's a house to protect them. If you don't pay them back, they get to take the house. So technically, until you've fully paid it off, the bank kind of owns it with you. Cute, right? So is a mortgage just a home loan? Yep, same thing. Home loan is the casual version. Mortgage is what the paperwork says, so don't get confused. It's not a trick, just fancy finance talk. And what's in a mortgage? Let's break it down. Say you're buying a house for $300,000. You put down $30,000 up front. This is called your down payment. That means you're borrowing the remaining $270 from the bank. That $270 is called your principal. It's the amount of money you're actually borrowing. For lending you the money, the bank charges you something called interest. Let's say your rate is 6%. That means that every year, the bank charges you 6% of whatever you still owe. Traditionally, these loans run for 30 years. This is called the term of the loan, or simply put, how long it lasts. And so, by adding your monthly principal, interest, and also property taxes and insurance, you get your total monthly payment. Here's a quick mortgage hack. You can actually pay extra toward your principal anytime. This is called prepayment. Let's say your monthly payment is $1,800, but you've got an extra $200 this month. If you tell the bank, put this extra money toward my principal, you're essentially buying a tiny bit more of your house ahead of schedule. The beauty of this, it can save you thousands in interest over time and help you own your home years earlier. Just make sure your mortgage doesn't have prepayment penalties. Most don't these days. Even small extra payments, like rounding up to the nearest $100 each month, can make a surprising difference over 30 years. It's like finding a fast-forward button on your mortgage. So, how does the bank decide what interest rate to give you? They look at a few things. First, your credit score. The higher it is, the more they trust you'll pay them back. Lower score, higher risk. Higher risk, higher rate. Next, your income. The more money you make and the less debt you already have, the more confident the bank feels that you can handle a loan. Then, your down payment. The more money you put down up front, the less the bank has to lend you. That makes them feel safer and generous. And finally, they look at the market. Interest rates go up and down all the time based on the economy, inflation, and whatever the Federal Reserve had for breakfast. Bottom line, the bank rewards people who look like they don't need the money. Weird, right? All right, let's talk interest rates. You've got two main kinds, fixed and adjustable. A fixed rate means your interest stays exactly the same for the entire life of the loan. Year 1, year 25, doesn't matter. Your monthly payment is predictable, stable, and as boring as it gets in the best way possible. An adjustable rate, on the other hand, starts low. You feel like a genius at first, but after a few years, that rate can go up, or down, or up again. It follows the market, and the market doesn't care about your budget. So yeah, it could save you money, but it could also turn into a financial horror movie if rates spike. If you like stability and not panicking during breakfast, you'll probably like a fixed rate a little better. Now let's talk equity. Let's say you're buying the $300,000 house. You put down $30K up front. That means you already own $30,000 worth, or 10% of that house. That 10% is called equity. You don't owe it to anybody. It's yours. And every time you make a monthly payment, a tiny bit more of the house becomes yours. Your loan gets smaller, and your equity gets bigger. Slowly but surely. Equity is just your ownership. That's all it is. You're buying back the house from the bank, one monthly payment at a time, like a super long adult version of layaway plan, except with more paperwork and grass to mow. Now here's something they don't tell you up front. Early on, your monthly payment is mostly going to interest, not the house. Let's say your monthly payment is $1,800. In year 1, maybe $1,400 of that is just interest going straight to the bank, and only $400 is actually buying you more of your house. But the cool part? This gradually flips over time. By year 20, most of your payment is going toward owning more of your home, not interest. This is called amortization, and it's why you feel like you're barely making a dent at first. It's like a snowball that starts tiny, but gets bigger as it rolls downhill. Patience pays off, literally. Now, let's talk about the part they don't put in the brochure. If, for one reason or the other, you just stop making your monthly payments, the bank doesn't just give you a mean look. They take the house. That's called foreclosure. And it's not fun. And even if you are making your payments on time, you're still responsible for everything else. The roof, the water heater, the broken dishwasher that starts leaking the night your in-laws visit. You've got property taxes, maintenance, random surprises, all of it. Owning a home isn't just paying the mortgage. It's adulting on expert mode. So with all that, why do people still do it? Because for most people, getting a mortgage is the only way to own a home. You don't need $300,000 in cash, just enough for the down payment. You move in, make your payments, and little by little, you build equity. Over time, the house becomes yours. It's not instant, and it's definitely not cheap, but it's one of the most reliable ways people build wealth. It's slow, it's steady, and one day, you wake up and realize you actually own the place. So there it is. A mortgage is just a home loan. You borrow the money, you pay it back over time, and little by little your home, well, becomes actually yours. Now you know what a mortgage is, so you can stop pretending at parties. Subscribe if you learned something, or don't. But if you don't, I'm charging interest on your attention span. See you next time.